Welcome to this welcome to this live room here at binary.com. Stumbled on my first few words there. Starting at 8 a.m. UK time, as always, of course. We're going to take a look at the Forex market. First of all, though, this presentation to be explained, hosted once again by binary.com. My name is Chris. And first of all, this disclaimer is valid, stating that trading for exchange and other financial markets is considered high risk and it may not be suitable for all investors and traders. Please seek the advice of an independent financial advisor for more information on that. This webinar is for educational purposes only and informational purposes only, and it's not advice. And by continuing watching this webinar, you agree with the disclaimer, you can always request a copy by going to binary.com and contacting your contact person there. First of all, please be aware that this is a live webinar, so you can always watch the recording by registering via blog.binary.com/weeklytradingroom. All right, let's start over and take a look, or start with the euro dollar, I should say, and take a look what's going on with this pair. Let me head over to Euro USD. Alrighty, we've been talking about the downtrend on the euro dollar, of course, for quite a substantial time. And it has lasted ever since this big bearish candle here, the downtrend since the beginning of May. So as we can see, some 8 months in the meantime, or almost 8 months, so lasted quite long. There have been a few weeks that were not bearish. Most of those bullish weeks were very small. This candle, this candle, this candle, this candle, these were very small candles. There have been about 2 or 3 exceptions. One exception was this bullish candle at the beginning of June. The other exception could have been perhaps this candle was bullish, and maybe these two, but here too pretty big wicks at the top. So all in all, not really bullish candles that indicate a lot of strength, I would say. The only one that did was probably this bullish pin bar, right? In that entire 8-month history. Last week was an exception. As I said last week and all the weeks before, the downtrend is, in my opinion, valid until I see something on a weekly candle level that shows that the downtrend is in trouble. That has lasted, as I said, for, well, the downtrend has lasted 8 months, but the downtrend was, in my opinion, let's say cemented ever since basically the beginning of June. So it has lasted about 7 months where I'm saying, okay, this is downtrend, just keep looking for a downtrend. Last week is the first time that things have changed. The dynamic has changed. It doesn't mean that we will get an uptrend. It doesn't mean that price will move up fast. It could just be very, very slow in its correction to the upside. But the chances, yes, that the downtrend are now, for the moment, over, are definitely a decent probability. Now, you might be wondering, what info would that give to me? How can I translate that into anything? First of all, it translates the fact that we shouldn't be as bearish as we've been the last 7 months. That's the first thing. So looking for shorts at this point in time is riskier. It can still be done, but it's not as attractive as it once was. Second is the fact that upside is actually a potential trade setup. Upside, although the trend is down, could make the most sense in this case based on this bullish candle. Now I know that's a lot of information just based on one candle, but that's how, this was my trading plan already at the very start. I said I'm going to keep riding the trend down until I see a clear signal on the weekly, and I'm going to be more cautious. This is the time that cautiousness has arrived. So that would be another strategy, just being cautious and not trading the euro dollar. But if you like reversal trades, then when price dips, the lower it gets to testing this bottom, the more likelihood of a bounce spot there is, and we could be retracing, price could be retracing last week's bullish candle for more upside after that. So anywhere, as long as price stays above last week's low, anywhere just near it or above it, even up to halfway, could be bouncing spots for upside correction. Now, how long could upside correction last? Now, this is, of course, looking more further into the future. And for some of you, this is not too relevant. But I think it's still handy because knowing what the target could be is I think, useful. Basically, price could stop at 23.6 fib and retrace from that 23.6 fib. So basically, if I make a drawing here quickly, what could happen is price goes down, retraces part of that bullish candle, finds support because we had a turnaround, and price moves up to the 23.6. Price stops at this because it's a resistance level, moves down, finds support again, and goes up to the 38.2 fib. Something like that. The most logical target is the 38.2 fib, then followed by the 23.6 and the 50. Price, yes, could go all the way up to the 50 fib. So, what could happen at these Fibonacci retracement levels? At these levels, looking at the entire structure of the euro dollar and the dollar, I am expecting again the downtrend to continue at these fib levels. The main one is the 38.2, but it could also be the 50 or the 23.6. And boom, price should head lower, down below 120. So if there's any path of least resistance, is there any probability path that seems the most likely at the moment, then in my opinion, it's the euro dollar here at the following lines that I've just drawn. Down to retrace the bullish candle up to the 23.6, down from the 23.6 up to the 38.2, and then a major fall. How long could this last, this up and down, up and down, up and down? We got holiday season coming soon, plus January is not known for a month that trends start. So I think the big fall, either from the 38.2 or the other two fibs, could be probably somewhere in February. That means we're going to have corrective upside, in my analysis at least, until end of January, beginning of February, roughly speaking. Extending into maybe later February, before a major downtrend continues. So it could be 4 weeks, it could be 5 weeks, it could be up to 8 weeks probably of corrective upside before we get a bigger downtrend. This is what I'm expecting at this moment. Could that change? Yes, because I'm not going to stick to analysis forever. When new information is available, I will use that new information to make a new analysis. That's how things go. That's how you of course, change your probabilities along the way. Right? Nothing is fixed probability. Everything is fluid. Everything is flexible. Depending on what information is provided by the market, I take that into account. For the moment, this seems the most likely. Could be different though 2 weeks from now. Right? We'll have to see how accurate this particular expectation was. And we can take a look at that, of course. So, is this a bullish candle for sure going to lead to a retracement of 38.2, 23.6, or 50 fib? No, it's not for sure. Nothing is in trading. But I think there's a decent probability. We have to know, though, that it is counter trend, and it's always a bit more riskier because of that. All right? So, otherwise, if we look at the potential for price here at this moment, as I said, anywhere around 123.60 down to 122.50 could be a bouncing spot for that upside up to the 38.2 fib and the 50. Now, what if price breaks below this bottom? Breaks below 122.40. Then the retracement that I'm expecting has not occurred. Or there's a high chance it hasn't or will not happen. I would have to reassess the situation and would be more bearish, of course, in the intra-week trading. All right, so if price doesn't make the fall, or does make the fall, but doesn't stop in the zone I'm expecting it right in here, in these green lines, but keeps falling instead of bouncing. If it breaks below the bottom, well, then things are looking differently, obviously, and would have to adjust my plan. And would perhaps try to take shorts below the bottom if there is potential retracement on the lower time frame. What if price exceeds the 50 fib? Well, then the bearish turn for a big downtrend didn't happen. And again, I'm going to be more cautious with shorts. Then the uptrend, in fact, that we don't know will happen as yet, but if it does, has been stronger than I expected. And if price does push above the 50, then the bearish environment is not as bearish as I thought. It's that simple. So I would have to reevaluate that, and would probably be looking for more longs at that point, right? On the pullback. But the 50 fib is here a key level. I wouldn't expect price to break above 130. I wouldn't expect it to go above the 50. If it does, something else is going on. It's an invalidation level for my analysis. At that point, the analysis I had in mind is invalidated. It's not what I thought it was. It's that simple. So those are basically my key levels and trend analysis here for the euro dollar. Now the interesting part, or maybe simple part about it, is that what I've just told you on the euro dollar is in fact exactly the same for the pound dollar and the dollar yen. There is really no substantial difference between these pairs. They all have similar structure and movement last week. Pound dollar, for instance, had a bullish candle too, after a major downtrend. Same story. The only difference, and it could be an important difference, is that I'm putting a Fibonacci level, from the very top. And the euro dollar, as you might have noticed, it's not the entire top, but it's actually this top. Right? Because there was a small pause before that. You see that? Here. That's a small difference. So the fib, from very top to very bottom, price could go back, in this case, to the 50. Another difference between the pound and the euro dollar is that I, contrary to the euro dollar, would not expect price to stop at the 23.6, but rather one fib higher. Whereas I said the most logical fib on the euro dollar is 38.2, and the secondaries are 23.6 and 50. On the pound dollar, the most logical is not the 38.2, but the 50. And secondaries are 38.2 and 61.8. With the pound dollar, I wouldn't call the invalidation level the 50, rather the entire top, because price could in fact retrace all the way to any of these fibs. With the euro dollar, I would not think that is so logical, or that is not so likely, I should say. So there is a difference. Invalidation level all the way to the top, not the 50. Most likely turning spot 50, not the 38.2. Secondary fibs, not 23.6 and 50, but 38.2 and 61.8 in this case. Now here too, what kind of info can you use with this? The info here that basically I think that there's an upside bullish reversal potential as long as price stays above last week's high, up to the 50 fib. First of all though, there's a chance that price could retrace last week's bullish candle. So contrary to perhaps other weeks where basically there could be setups right now, right here, this is a scenario where I am waiting first for certain developments to happen before trading it. I'm waiting for price to get into what I call high probability areas, high probability bounces. In that regard, all right, in that scenario, I like trading, I should say. Not regard, but scenarios. In those particular situations. All right, because of course, when there's a higher probability of something, it's better odds for us traders. So I don't want to trade when the probabilities are not that great, are not that favorable. In this particular scenario, I don't think the odds are. So why should I trade at a spot that I don't think they are? That doesn't make sense. So that's why I'm going to wait until either price retraces lower and look for a bounce up, either price gets to the retracement targets and look for downside, or if price does break last week's low, then well, something else is going on than I expected, and maybe it's more bearish than the analysis showed. Dollar yen, same story. Don't want to make it too boring for you, but here too, basically, roughly said, looking for a bigger correction. Of course, as you can see very clearly on this week chart, we are in uptrend. Price is moving very strong with a lot of momentum, higher and higher. And recently, the last few weeks too. In fact, moving up 16, 1700 pips. So yes, a lot of momentum. But last week, here too, was bearish. So price could stop at the 38.2 is the main target. 23.6 and 50 are secondary fibs at the moment. And I wouldn't expect price to get below the 50. All right, same like the euro dollar, in fact. Identical, of course, but then to the opposite direction. So let's see what the dollar yen would do. Then we have the AUD USD. Now the AUD USD is the exception, in fact. Now why? Let's take a look. Remember, don't forget that euro dollar, pound dollar, had bullish candles. Aussie dollar has a bearish candle. What does that mean? Is that dollar was losing against the euro and pound, but not against the Aussie. The Aussie remained weak. So the Aussie was the weakest currency pair of them all, if you compare it to the yen, euro, pound, and dollar. Why? Because the Aussie actually lost terrain against the dollar, whereas the euro and pound gained substantial terrain. So the Aussie was the exception here. The other three were dollar weaknesses. The Aussie had actually dollar strength, which was probably more caused because of Aussie weakness, obviously. So the Aussie weakness, is it a trade setup to look for? Is it something to trade? Well, yes. Obviously, if you look at only this currency pair, we can see the Aussie USD is in a downtrend, and last week was a bearish candle. So in that regard, looking for more downside makes sense. Okay? There's only one problem, or one thing to be aware of, is the fact that basically the other pairs are showing dollar weakness. So in that regard, I would be cautious with shorting the AUD USD because of the entire dollar situation. The other pairs are showing dollar weakness. So I would be cautious with trading dollar strength in general. The AUD USD, if it does move up to test last week's low, where we see the red lines there, could be, of course, a spot to think about further downside. But something to be cautious of, though. All right? That's basically what it is. So if we zoom in to the 4-hour chart and take a look, you can see those red lines there. As long as price stays below it, it's still in bearish territory. And as long as it stays below these blue lines, we're in a downtrend channel. So as price retraces perhaps back to the 83.20, 83 level, which could be a turning spot for more downside. All right, that's simple. Next one, last but not least, the XAU USD. It has been pushing up higher and higher, and I would be expecting a bit of a difficulties for the uptrend now as it gets closer to targets. Perhaps one more push up to 1250, which is a minus 618 target. It is making another bull flag. What kind of bull flag? This one here, like that, is showing the potential bull flag right there. And the same bull flag could be here on the most recent price action. Like that. All right. So in that regard, we see clearly the potential for a bull flag, and the break to the upside could lead to price going up to the minus 618 target. The break of this bull flag could indicate a long for at least a couple of candles. Right? More than 6 probably, but I would say less than 12 just in case we get a turnaround at the minus 618 target and a fall. Now with candles, I'm talking of course about the current time frame candles. These are 4-hour candles. So when I say 6 to 12 candles, I'm always talking about the time frame I'm looking at. So with the break of the bull flag, I would expect price to go up to the minus 618 target and then turn around again. That's all at the moment that I find interesting on gold. I mean, it doesn't make sense to look at the long term because of the fact that if we analyze the bigger picture, it really is it's just a tough one at the moment. It is in a downtrend, but it's retracing pretty sturdy. So we have to see if the downtrend can continue or if the uptrend remains in control. So that's simply put. So with that XAU-USD behind us now, we've wrapped up our weekly summary of these four currency pairs and one commodity. And it's time for me to thank you for joining us. Next week, we will not have a session. I will have a week off with the holidays. But 2 weeks from now, Monday the 29th of December, we will have our very last session of 2014. And we'll take a review, of course, at what we can expect during that week, but also how the December month, in fact, will end. And not only, of course, December, but in fact, the entire year. And take a quick look at what we can expect in 2015. More of what we can expect in 2015 will happen in the first session of 2015, which is Monday, the 5th of January, where we take a look at big trends that we could perhaps expect in the next year. So hope to see you in these two important webinars. And in the meantime, wish you happy hunting, good trading, and see you all soon. Cheers.